All right, in this video, I'm going to give you the 5 critical red flags that practically scream a business is a bad deal. These are the warning signs you can spot yourself by digging into their books and their history, so you can cut through the sales pitch, spot the lies, and protect your hard-earned money. I'm Santiago Cueto, board-certified international business law expert and best-selling author. And for nearly 30 years, I've been deep in the world of business acquisitions, helping buyers navigate these tricky situations. I've seen all the tricks, the half-truths, and the outright lies that sellers use to unload a failing company onto someone who doesn't know any better. So let's get right into it. Sellers are absolute masters of disguise. They'll paint this gorgeous picture of a thriving business, a golden opportunity that's just waiting for you to take the reins. But what if that masterpiece is hiding a totally rotten canvas? You might think that you found the deal of a lifetime, but you could be walking straight into a financial trap that will drain your bank account and your will to live. Look, buying a business is one of the biggest, most life-altering investments you'll ever make. This isn't like buying a used car. The consequences of getting this wrong are absolutely crushing. And that's exactly why I'm making this video. I'm not here to give you some vague checklist. All right, our first red flag is a classic sleight of hand. Declining profits even when revenue is growing. This is the seller's favorite magic trick. They'll proudly point to their top-line revenue, showing you a chart that only goes up. Look, they'll say, sales have grown 20% this year. And yeah, on the surface, that sounds incredible. Who doesn't want a growing business? But this is often just a smokescreen to distract you from a much uglier truth. The problem isn't the revenue, it's what's happening underneath it all. A business can easily jack up its sales by doing things like aggressively cutting prices, blowing a fortune on marketing, or taking on clients that barely make them any money. This creates the illusion of growth, but in reality, the business is becoming less and less profitable with every single sale. So here's your game plan. You need to become a financial detective. Demand at least 3 to 5 years of detailed income statements. And don't just glance at the top sales number at the top. You need to calculate the gross profit margin and the net profit margin for each of those years. Gross margin tells you what's left after paying for the actual goods or services that they sold. Net margin tells you what's left after all the bills are paid. If you see revenue climbing from, say, $1 million to $1.2 million, but then the profit margin has cratered from 15% down to 8%, you have a serious problem. That's a business that's working harder just to make less money. It's a sign of rising costs, brutal competition, or pricing strategies that just aren't sustainable. It's like a car that's going faster and faster downhill because its brakes are out. Don't be fooled by the speed. You've got to look under the hood. Next up is red flag number 2, heavy customer concentration. This is the classic, all your eggs is in one basket problem, and it's one of the fastest ways to watch your new business implode. You'll find a business that, on paper, looks pretty healthy. It's got consistent revenue, solid profits, but then they dig a little deeper and discover that 50, 60, or even 70% of its total revenue comes from a single client. Now that's a serious red flag. The seller will try to calm you down and say, don't worry, we've had them for 10 years, they love us, our relationship is rock solid. Well, that relationship might be rock solid with the seller, but it means nothing for you, the new owner. The second that key client gets a new manager, decides to switch vendors, or just brings those services in-house, your business doesn't just lose a customer, it loses its main artery. I've seen companies go belly up within a days of losing their one major client. The risk is just massive. So here's how you spot this and protect yourself. First, demand a customer list with revenue broken down by client for the last 3 years. The seller might want to keep the names anonymous for confidentiality. You know what, and that's okay, but you have to see the percentages. A good rule of thumb is that no single customer should be more than 15-20% of total revenue. Anything over that is a huge red flag. Second, you have to ask about the contracts. Are there long-term agreements in place? And most importantly, do those contracts have change of control clauses? Some contracts can be automatically canceled if the business is sold. You'll also need to figure out if the relationship is based on the owner's personal connection or the business's actual value. If the top client happened to be the seller's college roommate, you can bet that relationship is walking out that door right behind them. This next red flag is one of the most serious because it points straight to downright dishonesty. It's when you find major inconsistencies between the seller's different financial documents. Now, here's how it usually plays out. The seller's broker hands you a beautiful, polished set of internal financials. The profit and loss statement looks fantastic, showing you a super profitable business. You start getting excited, but then you ask for the official filed tax return for the same years, and the numbers don't match. The tax returns show way lower profits. This is a massive 5-alarm fire. When you see this, you're looking at one of two things. Either the business is committing tax fraud by lying to the government, or it's trying to defraud you by inflating its numbers just to get a higher price. Either way, it's a complete disaster for you. Walk away immediately if you see this. Now, the solution here is non-negotiable. You must get here and go over at least 3 years of official filed tax returns with a fine-tooth comb. These documents are your ground truth. Why? Because while a seller might lie to you to make their business look better, they are very, very, very unlikely to lie to the IRS just to pay more tax than they owe. When you compare the tax returns to the internal P&L statements, pay close attention. Do the revenue numbers match? What about the big expense categories? Any significant difference is a reason to get extremely skeptical. And while you're at it, have your accountant search for any tax liens or unresolved payroll tax issues. Companies in trouble often fall behind on payroll taxes, creating a hidden liability that you can end up inheriting. If the numbers don't add up, you walk away, period. Now, before we get to our last 2 red flags, which are arguably the most deceptive, understanding how to spot financial fraud in a business acquisition could save you from making a catastrophic mistake. Now, if you're finding this valuable, hit that like button and subscribe to this channel. I share expert insights on business law and acquisitions every week to help you make smarter decisions. Now, let's keep going. Red flag number 4 is one that never shows up on a balance sheet. It's a revolving door of high employee turnover. A business is more than just assets and cash flow. It's made up of people. Your employees hold the real-world knowledge, the customer relationships, and the company culture in their hands. If those people are constantly leaving, it's a symptom of a much deeper problem. Sellers will almost never volunteer this information. They'll brag about the great team, but if key managers or skilled employees are quitting every 6 to 12 months, you have to find out why. It could signal a toxic work environment, terrible management, and no room for growth, or pay that's way below market rate. Even worse, it might mean the whole business depends entirely on the owner. Now, if the owner is the only one who knows how everything works and the employees are just interchangeable parts, then you're not just buying a business. You're buying a very demanding job that comes with a mountain of new headaches. So how do you figure this out? You have to do some digging. During your due diligence, ask for an employee roster with their job titles and, most importantly, their start dates. Look at the average tenure. Is everyone brand new? Ask the seller direct questions about key people who have left in the past couple of years and get the real story on why they left. High turnover isn't just a management issue, it's a direct threat to the stability of the business. You could be left with a skeleton crew that has no idea how to keep things running after the sale. And now for our final and maybe the most tempting red flag, the seller who claims the business just runs itself. This is the ultimate sales pitch. The owner tells you, "Oh, I only work 5 hours a week. I just pop in on Fridays. The team handles everything. It's a truly passive investment." It sounds like an absolute dream come true, but more often than not, it's a fantasy they've built to get you to overpay. Let me tell you a quick story. I had a client who was about to buy a digital marketing agency. The owner gave him the exact same sales pitch. He swore the business was a well-oiled machine and that he was completely hands-off. The numbers looked good, the team seemed solid, and my client was ready to sign on the dotted line. But we decided to dig just one layer deeper. We asked the seller for a detailed breakdown of his weekly schedule and to see how his emails with his top 5 clients. What we found was shocking. While he may have only been in the office for a few hours, he was the sole rainmaker. He was the one taking clients to lunch. He was the one landing all the new deals, and his personal cell was the one clients called when something went wrong. The business didn't run itself, it ran on him. Without him, the client list and the sales pipeline would completely evaporate. He wasn't selling a business, he was trying to sell his job. The solution is to verify, and then verify again. Never take the seller's word for it. Ask for proof. Ask to shadow them for a day or two. Ask who is responsible for bringing in the biggest deals. A truly passive business is incredibly rare and is valued at a much higher price. If a seller is offering you a passive business at a standard price, you should be extremely suspicious. Chances are, you're the one who'll be working 80-hour weeks just to keep it afloat the day after they cash your check. So there you have it, the 5 critical red flags that should make you slam on the brakes before buying any business. So let's recap. Number 1, the magician's profit margin. Driving sales that are just hiding shrinking profits. Number 2, the one client wonder, relying way too much on just 1 or 2 customers. Number 3, the financial skeleton. Numbers that don't match between the internal books and the official tax returns. Number 4, the revolving door, high employee turnover that points to a sick culture or total owner dependency. And number 5, the overly disengaged seller, the dangerous myth that the business runs itself. Buying business is likely the biggest financial decision you will ever make. Don't go into it unprepared. If this video helped you understand what to watch out for in your next acquisition, make sure you like this video and subscribe to the channel so you don't miss our next video. See you in the next one.